Welcome to another episode of Money Health with Mary Heaton. If you watched the first 3 episodes, hopefully by now you've opened up an IRA or an investing account, depending on what your needs and your time frame are. So once you have the account is probably the most asked questions. What do I put in it? How do I invest it? Do I buy stocks? Do I buy mutual funds? Do I do bonds, CDs? What's the right mix depending on my time frame and the age? That's what we're going to tackle today. So today we're going to go on the surface level with stocks and everything, explaining the difference between all of them. And eventually in the next video, we're probably going to talk about mutual funds versus an individual stock versus an ETF or exchange traded indexes, everything that's fun. But today, let's get the basics down so that we understand the lingo that you hear all the time on the radios, on TV and everything, bringing you to become an empowered investor and planning your future. Let's go and look at some charts as well. Let's take a step back before we move forward. So if you remember in episode 1 where we compared Sarita to Chris and the investments over time, had they started at age 25 versus 35 and the possible values at 67. Well, obviously, both the scenarios were long-term. Both the scenarios were probably using a portfolio that was 85 to 100% stocks in an index fund or something similar to that. So we want to talk about the differences and remember that if it's long-term, if you're looking for this type of growth, you're going to need to take on some risk. I'm going to start with the least risk investments. Let's start with the easiest to understand, CD. A CD is a certificate of deposit. You could buy those at banks or you could buy them in a brokerage account. Basically, what a CD is you are loaning money to a bank. It is FDIC insured, which means Federal Deposit Insurance Corp. It's not necessarily a government insurance. It's an insurance that the banks, everyone pay into so that these are insured. If the bank itself defaults, CDs have a certain limit of coverage per social security number per account type. Again, that's a long discussion. Usually it's around 250,000. So if you are investing in a bank CD, you need to choose the time frame that you want to invest for. Is it going to be 3 months? Is it going to be 3 years? How long you're going into it? Then you're going to choose the dollar amount that you want to go into. Those are in increments of $1,000. Now, CDs are very safe. The chances of you losing money in them are slim, extremely slim, but they are very safe. However, if you remember the rule of 72 that we talked about, if you're only making 4% on your money and you divide that number into 72, that's going to take you a very long time for that money to double. It's going to be, I think, about 18 years. So the CD is probably not the best option. The other reason is CDs tend to pay just a little bit over what the current inflation rate is. So it's really keeping your money up with inflation. If you're buying a home, if this is short-term money that you're going to use in 3 years, perfect investment. After a CD, you have bonds. The difference between a bond and a CD is while a CD is issued by a bank, a bond is going to be issued by a government or a corporate office. Let me explain that a little bit better. Bonds, on the other hand, are usually issued by either a government agency or office or corporations that need to raise money. So bonds are issued by a government agency or a corporation that needs to raise money. So very similar to CDs, the same thing is they go in $1,000 increments. You basically choose the time frame that you want to invest. Now bonds are going to be more long-term. You can find bonds going out couple of years all the way up to 30 years. So again, you want to look at the time frame. They're also pretty secure, especially if you're going with a government agency. You're going with a corporate bond, you're going to run into some risk involved with it as well. And you're going to look at the different interest rates that are out there. So while bonds have outperformed CDs over the time frames, I wouldn't put all of my money in bonds in either, and you want to be sure that you're using a diversification method and not going just with one company. Look at stocks. Stock market has thousands of choices. When you're buying a stock, you're basically choosing a company. Hopefully it's a company that you believe in, that you want to own a part of it. So a stock is issued by companies allowing other people to have ownership into that company. Usually stocks are issued to raise capital when a company will go public. Sometimes they'll have a secondary offering of stock if they need to raise additional funds. So because there is ownership in that company, there's a little bit more inherent risk. When you're buying the stock, the reward could be higher. So you're looking at closer to 10% returns over time. Let's start making it easy. You need to invest for 1 to 3 years. You need that money to be there. You're going to look at a CD. You need to invest for the long term for retirement. You're willing to take on some risk. You need to be in stocks. You're still investing for long for retirement, but you don't want to take on all the risk. You want some of that money to be more secure. You're probably going to do a percentage in bonds, a percentage in stocks. I prefer government bonds versus corporate bonds because if that money's going to be safe, I feel a little bit more sense of security in it. That's me personally, though. Now, unless you have well over 100,000 and you're really good at stock picking, and you're following everything, it's going to be hard for you to diversify a portfolio. And even if you have over that much, picking individual stocks, not as easy as it looks. A lot of people will go with index funds, an exchange traded fund, or they will look at a mutual fund. What a mutual fund is, think of it this way. A mutual fund is basically a big bucket that has not 10, not 100, but it could have hundreds of different stocks and bonds in there. So it's going to have a lot of the companies that we were looking at. If it's a large cap, it could have a lot of international in it. It could have a lot of different holdings. So in the next video, I really want to go into explaining what mutual funds are, the benefits of the mutual funds, and all the expenses and everything that you're paying into it. I'll even give you a couple mutual funds that consistently have done really well that you could look at and research on your own. But the time frame is the number one driver of what type of investment you should be in. Your risk tolerance is going to be right up there side by side with the time frame. Good example is in 2000, 2001, and 2002. 3 years in a row, the stock market was down. If you were all in large cap technology companies, you could have lost about 60% of your portfolio. If you would have panicked and sold out, even at 2001 or 2002, anywhere in that time frame, you would not have had the subsequent gains that the stock market has given over the past 20 years. So you need to have a stomach for it. Let's look at some different type of investments you could go in. I am going to stick more at this point with exchange traded funds, broad diversification, and different mutual funds, as well as showing you the type of portfolios and the returns over time so that you could be more informed as an investor, empowering you to make your own choices. But for today, the explanation was CD, bank issued, bonds, either bank or corporate issued, stock, ownership in a company. Therefore, if the company's doing well, you're going to do better. If the company's not doing well, obviously you're not going to do as well. Company goes bankrupt, you lose everything. Company does wonderfully, you make a lot of money. That's the simplification of it. I'm trying to keep these easy for you as possible.
Please let me know in the comments what you first started investing in, as well as any questions that you might have. So it's always good to hear from folks. This is what I started with. This is, why I did the individual stocks or not. Just a couple of words. Thank you so much for watching.